Looks like we're live, my dude.
Hello.
What's up, guys? Welcome back to the College Info Geek podcast. I am Thomas Frank from College Info Geek.
I'm Martin Bamey of the Golgari Swarm.
And
Shout out to the
you're
Golgari
a nerd.
Swarm.
I think 4 people will get that reference.
Shout out to Jake if you see that.
I wonder if Jake watches this podcast.
I don't know. I'll just
Maybe he does
like
every once in a while.
I don't know.
Ooh, this is our way to get Jake to watch the podcast.
Yeah.
That's been the plan all along.
Just slip magic references in until he's invested.
What are we at, 168 episodes? It's 168 tries to get Jake to watch our podcast. That's all we've ever been trying to do, actually.
I never thought about the fact that number's really big.
Yeah. Not you, but I've been podcasting for over 4 years now.
Yeah.
Which is really weird.
That's crazy.
That's really weird to me. I don't understand it.
And I got reactive in the late 90s.
Wait, what?
Episodes in the late 90s. I got back into the podcast.
I thought you were saying, I started podcasting back in when The Matrix came out.
Yeah, I heard myself say that and I was like, wow, that really just sounds like the time period. But
when I was 6 years old.
Whatever.
You know.
Well, I've been podcasting since I was in the womb.
That's a good...
Just give me a mic.
There's an interesting question. When is the first time in your life that you deliberately recorded your voice? Because obviously your parents probably did home videos or whatever without your consent, because the parents do. And then of course they play it at your graduation party, so your girlfriend gets to see a video of you eating your own poop or something.
What?
I don't know. I've heard stories about that.
I never went to Tom's graduation party, so I don't know that this is a fake story.
I did not eat my own poop when I was a baby.
Don't trust him.
Though there is an embarrassing video of me lying to my mom about something related to that, and they did play it at my grad party, and my friends all laughed at me. I thought it was funny, so I didn't mind it.
All right. I think my answer is probably for music in high school at some point.
Okay.
Just when I was writing stuff for piano and guitar.
I think for me, I probably recorded video before audio only. Because I remember my brother and I saved up a bunch of money together. We went to Walmart and we bought this really, really crappy tiny blue camera that shot in 240p. Just the blurriest stuff.
That's high definition.
The microphone was terrible, and we just went out and made videos of I don't know, beating each other up with those plastic baseball bats. Or
I have videos like that.
Yeah, we just have all those dumb videos, and I've got them buried on my computer somewhere. They're fun to go watch every once in a while, but yeah. So maybe, I don't know, 10 or 12 years old.
Yeah.
And that was the start. Anyway, we should get right into the topic of today's podcast
nostalgia.
Because we have a lot to cover. So, guys, today we're going to do an episode on investing basics. I've gotten a lot of questions from you about how do I start investing my money? When do I do it? How do I deal with my student debt versus the question of should I be investing? So, I have put together a pretty big outline here. For those of you watching here on YouTube, you can see I've switched to my iPad because I felt like we had too much computer and stickers in the desk last time.
High tech.
So I'm going to try to go with the iPad here. But yeah, I've got a lot of stuff I want to go through, and I think this is one of the only recent episodes where you have almost no experience.
I've never invested.
Yeah.
Yeah, I got nothing. I am the student in this episode. However, I was once taught that cash rules everything around me. Cream get the money, dollar bill, y'all. That's the extent of my investment knowledge.
That is true. Cash does rule everything around you.
That's good? Verified?
Yes, absolutely. All right. Wu-Tang Financial is actually my financial services firm of choice.
Good.
And I would recommend that everyone just turn this podcast off now and go invest all their money with them or put it into gold.
Fair. But in all seriousness, I'm actually thinking this is the year that I do want to start thinking about investing. So I'm very invested, no pun intended,
in
this episode. It wasn't because the first word I thought of, and then I was like, I wish there was another word, but I couldn't think of one fast enough.
Okay.
But I care about this episode.
You're very keen on this episode.
Why would I think of that
Commander
word first?
Keen.
I'm very keen on what we're going to talk about today.
It's Commander Keen, right?
I don't remember.
The old video game series?
I don't know.
I think it is.
I don't know.
Or Keenan and Kel? All right. So I have been investing for quite a long time. So welcome to school, my young Padawan.
Yes.
I am the Darth Jar Jar to your Palpatine, because that's the canon that I'm going with.
That's because Darth Jar Jar is amazing, and that theory makes Star Wars a trillion times better.
How much you want to bet we get more comments about that line, offhanded reference, than to everything we're going to cover here?
Well, I don't know. Is gambling a good investment, Tom?
Isn't investing just another word for gambling?
Yeah, but what about short-term gambling based on Star Wars stuff? Is that a good investment?
That's actually
What's
my
the
recommended investment strategy. Yeah.
Well, then we're done. That's the episode.
We're done. Yep. Covered. No. So I've been investing since 2011, I want to say. That was my sophomore year of college. And I picked up a book called Your Money, The Missing Manual by J.D. Roth, who I've had the pleasure of meeting since then. He's an awesome guy. I'm trying to remember the name of the blog that he started. I think it was Get Rich Slowly. It was one of like the OG personal finance blogs. And he put together this book as part of the Missing Manual series. I read it and it was like my first real introduction to like a lot of the personal finance concepts that are good to know. I did read Rich Dad Poor Dad as well when I was a teenager. But that book was almost more like about why you should start a business. So that was kind of useful as well. But this book was like, here's what an IRA is. Here's what a 401k is. Here's why you should invest. And savings accounts versus checking accounts. And inflation. All the stuff that's important to know that they don't teach you in school for some reason. So I remember this pretty clearly. I had read that book. I was sitting in my Java programming class, not paying attention. I don't want to say as usual, but as I did sometimes.
Fair.
And I was like, you know what I should do? I should start investing. And I had, I think, like $1,000 in my savings account. So I went looking for funds that I could invest in. And so I went to Vanguard because Vanguard is the place that had been recommended to me. But a lot of the funds that I wanted to be invested in had like a $3,000 minimum. Or sometimes like a $10,000 minimum.
So not student friendly.
Yeah, not at all. Like most students don't have $3,000 sitting around to invest.
Yeah.
And I certainly didn't. I think $1,000 was actually pretty good. And I think I had the $1,000 only because I was working 20 hours a week and I had taken loans to cover my dorm. So like I was working just to make bank pretty much, which is a nice situation. But I'm like, man, $3,000, I can't do that, but I want to start investing. So I ended up finding this Vanguard fund. It's like, I think it's called the Star Fund. It was like their only fund at that time that had $1,000 minimum investment.
So they have multiple. Vanguard is what, like a company, and they
so yeah,
have different
Vanguard
choices
is a
of funds.
Big company. So yeah, to put this really simply, there's like all these companies out there that offer mutual funds you can buy into. And mutual fund, I mean, we'll define more of this as we go on, but a mutual fund is basically like a big collection of like stocks or bonds or any kind of investment. Basically, like if I were to make it like really boiled down and simple, I'd go out and buy a bunch of stocks. And then I'm like, but I wouldn't use my own money. I'd go to you, I'd go to Anna, I'd go to your mom, I'd go to a billion people, and I'm like, hey, each of you give me $10. And I'm gonna make a giant pool of this money and I'm gonna invest it in things that I think are a good idea to invest in. And then you're gonna get the profits for whatever you put in.
Yeah.
So instead of you having to pick what you put money into, you just kind of put it all into this pool, and then whoever manages the pool, or based on some logic, that's what it gets invested in.
So you're trusting, I don't want to think about this, cool, smart people. Please do smart things with my money for me.
Well, as we're going to talk about, it's either cool, smart people making decisions or some other sets of logic or sets of rules, which are sometimes better than smart people, and I'm going to put that in quotes, and you'll see why.
Okay.
But so the Star Fund was all I could invest in. Now the Star Fund is pretty evenly balanced between stocks and bonds, and bonds are usually less risky than stocks. So like if a company goes bankrupt, bondholders get paid first. That's one of the big reasons why they're less risky. But with less risk comes less reward. That's like the iron law of investing. Higher risk equals higher reward. Otherwise, everyone would go for the high reward thing and it would never pay out. But when you're young, a high risk like stock only portfolio is a better option because you've got time. If you can take a punch basically. If the market goes down, you've got time to work your way back up. Whereas if you're 50, obviously high risk is a bad idea because you're getting near retirement.
You've got more responsibilities at that point. So you have dependents maybe that rely on you. So you can't just
all these things.
I'm just going to be super poor for 3 months if this goes wrong. But you can't say that if you've got kids you're trying to feed.
Yeah. So ideally, being a 19-year-old kid, I would have wanted to get into something a little bit more aggressive, growth-minded, but I didn't have enough money. So I put money in the Star Fund and I just started contributing like $20 a month to it sometimes.
Okay.
So it wasn't, I tell this story because it wasn't the perfect start. And I think this is what gets people so hung up on investing. they start to get this idea in their mind that I should invest, but I got to go research and I got to find like the perfect investment to put my money into. And then they don't.
No, then they wait for years and years trying to learn enough.
Exactly. And then they never get money in here. And the whole thing with investing is like the longer you invest, the more money you're going to make by far. And I'm going to give you guys a quick example of that in a second here. So there's a researcher, I can't remember which university she's from. Her name is Sheena Iyengar, and she's done all this research into how choices affect us. And you know that story I told you about the fish market that had dozens of fish and dozens of rubs, and their sales were terrible. And then they cut down to 3 choices, 1 rub per fish. Basically, like you can just choose the tuna, the halibut, or the salmon. That's it. Yeah. Sales go up. Same thing with retirement and investing options. Since there's so much, people are often driven to not choose anything.
Yeah.
So basically, like the big thing I want to put into your brain, because you're wanting to do this, but also to anybody who's listening to this, with some caveats I'll get into later on, is start investing as soon as you possibly can.
Start investing right now.
Yeah.
No, I'll probably wait till the end
right
of the
podcast. Right on the podcast, yeah. You know, you're going to be typing in your social security number and everything.
Maybe I should say it out loud while I type it, just so I don't mess it up.
Yeah, you know, just like looking at the screen real quick. All right, 2, 4, 5, I don't know.
Yeah.
That's actually the first 3
numbers. It's 2468
8675309.
Yeah.
That's
it.
Oh my God, I wonder if somebody's social security number is that. Well, there's more digits than that in a social security number. But like
I don't know. I don't want to count digits right now. I'm confused.
I think there's 9.
I can't think about that.
In a social number. And there's 10 or 7.
These are not the digits I want to be counting in this episode.
So anyway.
I want to get rich.
I did that, and then eventually I switched my money from that star fund into better funds. So for anybody curious, I'll just tell you right up front, I'm invested in Betterment, which is a company that's called a robo-advisor, which basically means that instead of a human just trying to pick the stocks based on their intuition or research, there's all these computer algorithms and AI that's been programmed to balance money as efficiently as possible into a number of different funds.
That sounds cool.
So it is pretty cool. I like robo-advisors. Betterment is one. We talk about it a lot on my other podcast, which is called Listen Money Matters, for anybody who's curious. There's one called Wealthfront. There's one called Wealth Simple. There's many of them actually nowadays. And the cool thing about these is you get some of the more active management benefits where the algorithm is kind of moving things around based on your risk profile, your age, you know, what's going on in the market. But because computers are doing it, you're not paying some fat cat fund manager $1 million a year to do it. And the fees,
so they can do it so efficiently that their profit margin doesn't have to be as high.
Exactly, yeah. Because the thing with any investment fund is there is like a portion you pay as a fee to whoever's managing it. And some funds have higher fees than others. When you let robots do the managing, the fees are lower than when you let humans do it.
That's cool.
And when you let simple logic and rules do it instead of robots, the fees can get even lower than that. So part of my money's in Betterment. Part of it is in the Vanguard Total Stock Index Fund, and it is in the Admirals Edition, which is basically like a version of the fund that is very, very cheap in terms of management fees, but it has a $10,000 minimum. So I basically like saved up money in my little star fund that I started out when I was 19 until I hit 10,000, and then moved it all over to this better one. And then some of it is in what's called a REIT, which is like a real estate, I forget the last 2 letters, but it basically like follows big swaths of the real estate market. Mm-hmm. So I've just basically done that to diversify. And this is a good thing to learn. Like diversification, not having all of your eggs in one basket is a good idea, because if that one basket falls into a fire, all your eggs are cooked prematurely.
Yep.
And now you got to eat hard-boiled eggs for the rest of your life.
There are worse fates.
There are worse fates, because you're going to have bad gas. So put your eggs in many different baskets and you're going to be good.
Okay.
So I say those. I have done the research. I believe that these are good investment picks for me. But one thing I do want to put here first and foremost is that past performance, what has happened in the past, is not an indicator of future performance. Something could happen tomorrow that could destroy all my funds. Who knows?
Yeah.
But, and I mean, this is what people always say when you talk about investments. Past performance is no indicator of future performance. The one thing about it is that's the data we have. So, I mean, you can like try to look at trends and stuff, but really like the data we have is what has happened in the past.
So past performance isn't everything, but it's also like, it's not, you shouldn't discount it entirely
exactly
when making decisions.
So, and that'll factor into why I chose those specific funds, which we'll talk about in a second here. The first thing is I want to give you guys an example of what investing can do. So, do you know what compound interest is?
Yes.
Basically, for anybody at home, simple interest, if you put money into investment and say it makes like 5% interest. So, really simple example, I put $100 in the bank and for whatever reason has a 5% interest rate. After a year, I'll have $5 that investment has gained me.
Yeah.
$5. Boom.
Rich.
Now, most bank accounts are going to give you like 0.01% interest because they suck.
Oh, yeah.
They're not investments, but that's just a really simple example here. Compound interest means you take that interest and you put it right back into your investment. So now I've got $105. And the next period it compounds, so the interest is now on 105 instead of on just the original 100. So the real good investment strategy here is long-term, be putting money regularly into your accounts, and also, and this usually happens automatically with most of the funds that we'll talk about, the interest gets reinvested right back into that account as well.
Okay.
So this is amazing. And I don't remember what famous person said it. It might have been Ben Franklin. Said like compound interest is the eighth wonder of the world.
I have heard this.
Maybe you've got the Google machine right there. You can actually find out.
I want to say it's potentially Einstein.
Who is it?
Einstein?
Oh, is it Einstein?
Yeah.
Okay, yeah, Einstein.
Could be fake news.
Not Ben
it's
Franklin.
just the first thing I found on Google, but you know.
Actually, Chuck Norris said that.
I thought it was Einstein already. So
okay, we'll go with Einstein.
I don't know. Goodreads says it, so I'm going to trust them. I'm going to say probably.
So here is why compound interest is the eighth wonder of the world. Say you are 20 years old. So I started my investing at 19. It's not unheard of. Say you're 20 years old. And you start with $1,000 in the Star Fund or whatever, like I did. So let's say you invest just $300 a month into your investment for 45 years, which would get you to age 65. That's retirement age. So $3,600 a year total. Okay. For some people, that's a lot. For some people, that's very little. But it's a good average here, for an example. Now, if you are invested in the types of funds that I'm invested in, like the total stock market index fund, which I'll explain in a second, you can basically bank on having a 7% average return on the long term. This is based off of like the data we have for decades going back to like the 50s or 40s. Basically, like some years are going to be up, some years are going to be down, but on a long time scale, you can kind of bank on 7%.
Okay.
So if you had $100, it'd be like 107, but over the long term, it's compounding. So based on those numbers, 7% average, investing for 45 years, $300 a month, you're going to end up with $1,088,301 when you retire.
That is a little bit more than the original number.
Yeah.
A little bit.
You're investing, I forgot to calculate it here exactly what you'll invest. Can you do a calculator real quick? $3,600 times 45.
Do you think I can type numbers?
Yes, I do.
162,000.
So $162,000 plus the original $1,000 you invested. You are only ever putting in $163,000 to get retiring with over $1 million.
Yeah.
So you're almost, I don't know what the word for times 10ifying, but your money increases by almost a factor of 10.
Yeah, we'll just go with times 10ifying.
Yeah,
that's
times
fine.
10ifying. And it's not even exactly 10, but it's a lot. So this is how you build wealth for retirement. You have to invest and utilize the principle of compound interest to make your money work for you rather than you having to work for every single dollar you ever make. And as we can see in this example, if you do it right and you start early, and the key is starting early, your dollars will work 10 times as hard as you can, which is pretty awesome.
Yeah.
Now, I don't want to discourage anybody who's watching this maybe a little older from not investing. Yeah. Obviously, you don't reap the benefits of compound interest because you're older, but that is not a reason for not investing because some benefit is better than no benefit. So
that's ridiculous.
Just to put that up front. Okay, so the big question that a lot of students and people who have graduated from college already are going to ask is, what if I have student debt? Should I start investing now or should I pay off my debt first? I'm actually interested to hear your take on this because you still have student debt.
I do
and
still
you're
have
thinking
student
about
debt.
investing now, and you've got enough that it'll probably take you at least a year or two to pay it off.
Okay, well.
So what are your thoughts here?
My thoughts are that psychologically, I would love to just kill my debt real fast first before investing. And I'd like to double check here, but I am fairly certain that because I only had government-backed helped loans, that their interest rates are actually lower than that average 7%.
Yes.
So I suppose logically speaking, or mathematically speaking, it is likely that I will benefit from investing now and continuing to pay off my loans as I go.
Yeah.
Rather than say if I had like $30,000 right now, it would be better for me to potentially put it into investments than to just knock out my loans.
Yeah. So I guess my question to you is, would you be comfortable doing that?
I would be comfortable doing that, but I am still likely to pay an accelerated rate of getting my student loans done.
Over the minimums?
But while still investing. Yeah, I would probably still pay more than the minimum just so that psychologically I do want them gone because I don't like juggling the commitments in my brain.
Yeah, that's true.
That takes my focus away sometimes. It's stressful. So that has value to me, but it means that I'm not going to just wait until my loans are completely gone to start investing, because like you said, the investments, the sooner you start the better. And if I can start now, but it still might take me a year or two of like crazy concentrated saving to kill my student loans, then I could have been investing that whole time.
Exactly, yeah.
So,
and I wanted to get your mindset on here because actually when I was a senior, I got it in my head that I wanted to pay off my student loans as fast as possible and I wanted to graduate debt-free. So I actually paused contributing to my investments for a while, and I put basically like every single dollar I had of extra money into that debt, and I did graduate debt-free. But for me, it was a mindset thing. I really wanted to be able to graduate without having this ball and chain shackled to my ankle of debt, because I knew if I had debt, that's an extra monthly expense and that limits my options. And I didn't really know what my options were going to be when I graduated. So I was like, if I don't have debt, I have more options. So I want to point that out because the first question you have to ask yourself when you're weighing these two possibilities, accelerate debt payments or invest, is where's your mind at? Are you psychologically troubled by having debt or not? Because at that time in my life, I was.
Yeah.
Now I'm not. I've got a car loan. There's still about $7,000 principal on the car loan. I don't care.
But like the interest rate isn't very high, so it wouldn't make sense for you to just dump it all in there, right?
So that brings us to the second point here. If you are comfortable with paying off your debt a little slower than you could and chipping into your investments instead, it makes sense mathematically if you can make more on the investments than the debt is costing you.
Yeah.
So the car loan I have is 2.49% interest.
Pretty low.
Very low.
Very low.
When I was a student, my loans, because of some government thing that happened for a very limited time, they were like 3.5% interest loans.
Mine, I just looked. Mine are like anywhere between 3.4 and 5% on the smallest chunk, but like no higher than that. So 7 is still a little better.
Yep. So this is kind of my general rule here for deciding this on the math basis. We go with that 7% interest in the market, but there's always a little bit of like margin that I like to put in there for error. So my rule is if you want to go the math way, make sure there's a 2% spread on the gain you're going to make. So like if any debt you have that is over 5%, I say pay that off as fast as you can before you start investing.
That's coincidental that my highest is exactly 2, below 7.
There you go. Yeah. Anything below that, obviously go with what you're comfortable with. But mathematically, I think anything below that, pay the minimums, pay it off, and use any excess to invest if you want to maximize your gains while also minimizing risk.
Okay.
So that's kind of my mindset here. Now, there's also another consideration. This, I believe, happens before you pay anything more than your minimums on your debt and before you invest. You get an emergency fund.
Ah, yes. For your normal expenses times some sort of number.
Sort of. So this is where like Andrew, my co-host, and I over at Listen Money Matters, and I kind of like debate a little bit.
Okay.
Because Andrew makes a good chunk of money, and he has for quite a while. And I mean, like, I make a pretty substantial income now, but I was a student 5 years ago, so it's like, or 4 years ago. So I understand what it's like to make basically nothing and be able to basically cover your monthly expenses and have not much left over.
Yeah.
So what he used to say is, you want to build up 3 times your monthly expenses in your checking account, and then have an emergency fund of like $1,000 before you start investing heavily. And I'm like, for most people I know, 3 months, month expenses, that's tough to build up in your checking account.
That could take a while.
It could take years sometimes. Some people have like $100 left over per month. If your monthly expense is like $1,500, like that takes over a year to build up 1 year's worth. So in my mind, when you're young, when you can take a punch, $500 is like the minimum I would say for an emergency fund, and keep that fund in a savings account, not in the market.
The older you get, the higher that needs to be, right?
Obviously,
because now
kids,
I've got way more stuff, like way higher rent than a college rent would be. Lots of stuff that makes it so an emergency fund should be a little higher. Yeah,
I mean, I feel like once you build up a significant amount in your investments, like that can almost act like a cushion, like an emergency fund of its own. Like I've got enough in my Vanguard account that if it took a 15% cut, there's still enough there that I could basically cover any emergency I'm going to have.
You could withdraw like whenever you want then on most of those?
We'll get into that.
Okay.
We're going to get into that because that is the difference between like retirement accounts.
Yeah, because I thought that was different for retirement plans.
Yeah, so we'll get into that. I've got that here on the outline quick. But, if you got a car problem, and this is a big thing, I want you to be able to take a punch and like be able to guarantee you can. So what's a punch? Like you need new tires in your car, or you have a tire blowout and you need that car to get to work.
Yeah.
Don't put the money that you're going to use to fix that car at risk by putting it in the market. Because again, we say 7% on average long term, but year to year, right now, I can tell you my Betterment account is 16% up, which is fantastic. My Vanguard total stock is 11.5% up, and my REIT, which is that real estate thing, that's 9% up. So it's a dang good year right now.
Okay.
But next year it could go down.
Yeah.
It could just as easily be 15% down. And if you got $500 in there and you lose 15% off that, now you have $425. What if those tires are $475? So keep that $500.
So some chunk should be risk-free.
Exactly.
Some chunk should be without risk.
Should be risk-free. It should just be there if you need it.
Okay.
And you shouldn't be pilfering it for like fun things. It should be like if you have an emergency come up, use that. So build that up first. The other question is, I think a lot of students are going to be watching this, so this is not... Well, actually, no, this could apply to students. We get questions on the podcast, Listen Money Matters, from people who want to buy a house. They're like, hey, I want to buy a house in 2 years. And obviously, when you buy a house, you got to save up a down payment of 20% of whatever the house costs. So I want to buy a $200,000 house, then I need to save up $40,000. So we get questions from people saying, like, should I put what I'm saving for my down payment into a Betterment account or into a Vanguard account or into some sort of investment? And our answer is usually no, because the gains you're going to make over 2 years aren't very high. So like the reward doesn't really match up to the risk you're taking.
Because the investment's more of a long-term strategy.
Exactly. It's a long-term strategy, 10, 20, 30 years.
2 years, it's on average 7%, not in 2 years you will have 7%. It could take 10 years for that to be realized.
You could like have bad timing and you put your money in and it's like the 2 years that suck. What if somebody like put their money for their house into the market in 2007?
Yeah, I was just thinking
that. 2008 happens.
You ain't getting a house.
It's all gone.
It's done.
Well, actually in 2007 they were giving out houses like candy.
That's true. But your down payment money is gone.
Yeah.
I guess you're lucky because specifically the housing market got messed up.
Yeah.
But still.
So here's how this question applies to students though. Say you're like, I got to buy textbooks in August, or I got to buy a car soon or something. Or I got to go buy like a $200 suit for my internship that's coming up. Yeah. Should I keep that money in the stock market? Again, that's a short-term expense. So I say save that money in a secure place, savings account.
Yeah, because you don't want to gamble away your short-term. Also, especially for like a lot of those are investments in yourself. That suit's going to pay you a way bigger ROI if you get a job than the 7%, because you might be making 2 to 3 times what you made, and especially more than that suit cost.
Yeah. Now, I think you or anybody else who's thinking about investing is already long-term minded.
Yeah.
Otherwise, you wouldn't be investing. But this comes back to the idea of mindfulness and looking into the near future to see what's coming up. So you need to have the presence of mind to ask yourself, what am I going to have to pay for in a couple of months? Is the next semester coming up? All right, textbooks. I can't ignore that expense.
Yeah.
I can't ignore any fees. I can't ignore whatever I might be paying out of pocket for tuition or dorms or whatever it may be. So all that has to be considered before you decide to invest.
Yeah.
Once you do, then take that debt consideration into account, and then figure out what you want to start investing.
That makes sense.
Cool. All right.
Don't
so
overinvest for the short term stuff.
Yes.
Like
exactly.
if I was going to buy 1,000 pens right now for some reason, because I know long term I'll need pens.
Why would you do
And
that?
I'll save 7%. But that's stupid because short term there was no reason to do that.
Plus, you can just go.
You can't think only long term. Short term is also important.
Just go accidentally put the pen behind your ear at the bank. You got a new pen. There you
1,000
go.
times.
Yeah.
Done. That's an investment.
1,000 times.
That's an investment.
You take a penny from the tray.
Steal pens from the bank.
You know the
That's bad
pennies
advice.
at the gas station that are for everyone.
Yeah.
You just take it.
Yeah, that's
well, you
what
go to
they're-
a million
that's what
gas
they're
stations
for.
and you take the pennies. And
Yeah. Well, I just think that's important because I'm often a very investment minded. So like, if you think about things like Sam's Club, the whole point in those is investing in a material product.
Yes.
But if you didn't need 9 million rolls of toilet paper right now, maybe there was a way better investment short term you could have been making.
That's what a lot of people don't understand. And that's actually kind of the mindset I took with the car that I bought.
Yeah.
Because like, I knew I could save up and buy a car in cash and wait. But your car was dying.
Yes.
And I was like,
Yes, it was.
I was like thinking in my head, my car is getting up there in miles. It's still a good car.
It's got a
but
lot
it's
of miles
old.
on it.
It's still running actually.
Yeah, it's running. It's got like 240,000. It's still fine.
I'm surprised it's still going. But back then I didn't know that. And I'm like, okay, my car is going to die someday. And Martin needs a car now.
Yeah.
And I know I'm going to buy a car. And I am in a financial position where I will buy a new car sooner than he will. So I'm just like, all right, I'm going to sell you my car for cheap. And I'm going to go take out a car loan to get my loan or to get my car.
Yeah.
Because I knew like that was an opportunity where it's like I should get one now. And
Yeah, it's short term. It made sense to do it at that time.
And because the interest rate on that is so low, I shouldn't be paying it off
Yeah.
all right now because it makes more sense for me to put money in the market where I can get a better return.
Yeah.
So this brings us to the question of what investment strategy do I use? So we talked about earlier, you can pay somebody who's quote unquote smart to make your investment decisions for you.
Okay.
You can try to make decisions yourself. You could try to buy individual stocks. You could try to buy investment like real estate properties and
I don't
then,
trust
like,
myself.
rent it out to people and make money off of that. There's all kinds of different investments out there. It really breaks down into two different categories. You have passive investing and you have active investing. So passive investing is the type of investing that follows a simple bit of logic or rules. And the main example here is what they call index funds. So an index fund is basically a fund that just like tracks a bunch of different stocks and just buys all of them. So like the S&P 500. Standard & Poor's is a company. They track like the top 500 US companies that are public. And if you buy an S&P 500 index fund, that is a fund that simply buys all 500 of them, and just follows them. So it's not trying to be like, I wonder if Apple's going to go up this year, Walmart's going to go down. Let's like sell
It's
Walmart
just
by
like,
Apple. It's
these
just like,
guys do well.
no, we're
Let's
invested
just
in
go
all of
for it.
them. So basically, you're not trying to bank on the performance of one company. You're banking on the performance of all 500, which by extension is a representation of you're basically banking on the performance of the entire economy.
Yeah.
So
Okay.
that's passive. That is what I recommend for most people, but I'll explain active here quickly. So active, again, it's you're picking stocks yourself, or you're paying somebody who is a professional fund manager to pick stocks for you, or you're buying real estate properties or whatever it is. Most people are not going to try to pick stocks themselves. Most people who get into active management are people who are going to buy a fund that is managed by a human being. So like say Warren Buffett's managing a fund, I want to be in his fund. Actually, you can buy shares of Berkshire Hathaway, which is Warren Buffett's company. And because Berkshire Hathaway has invested in so many other companies, that's like almost a de facto way of getting a weird mutual fund. But I digress. The thing here, and I think I had some research that I may have put lower down here. Where did I put it? Yeah, here it is. All right, so Standard & Poor's put out research this year in 2017 that shows that 92% of actively managed funds, with all these smart people managing them and taking a pretty hefty fee for it.
These are funds. They're not just 92% of people who invest by themselves. These are the smart people.
These are funds that are run by professional hedge managers, fund managers, it's their day job to pick the stocks that the fund's going to have to give it good performance.
So experts in quotes here.
Yeah, and they're taking a higher fee because of it. 92% of them don't beat the simple S&P index fund.
So, yes.
So the lazy man's passive strategy of just putting money into an index fund and following the economy will beat somebody else's picks 92% of the time. And if you think you're smarter than an active fund manager,
I don't.
Well, maybe you are, but you're probably not.
Yeah.
So my recommendation for the beginning investor is get into an index fund, like the Vanguard Total Stock Index Fund or the Vanguard S&P. Fidelity has some as well. There might be other ones out there that I don't know of. Vanguard is kind of like the go-to for most people because it's very, very cheap. There's like a very small fee on it. But yeah, active is not that good. Now, on Listen Money Matters, what we usually say is build up $25,000 in passive funds. So for a lot of people, that means like you're probably going to spend like a decade building that up.
Yeah, it'll take some time.
So, you know, this is long-term minded, as always. Once you get there, if you want to start dabbling with active things in your free time with a little bit of your money, fine, because it's unlikely to hurt you.
So once you've built up like $25,000 in low-risk stuff over a long period of time, after that, you can get a little risky if you want.
Yeah, and you're saying safer. I'm not saying build up $25K in that passive thing and then start taking all the money you would invest from that point on and buy an Apple or whatever.
Yeah.
I'm saying like, say you put $500 a month in, and then you hit that $25K in your account. All right, now put $400 a month in from then on to that one and take your extra $100 and do something else with it.
Yeah.
Like if you want to buy individual stocks, for example, there's an app called Robinhood, and Robinhood is really awesome because it's on the iPhone. It might be on Android phones. It lets you make individual stock purchases from your phone with no commission. That's like the catch. That was like the kicker for most people for like up until a few years ago. If you went through like E-Trade, Scottrade, whatever, random dude who runs a brokerage down the street, they were always going to charge you like $10 or $15 per trade. So like if
trade really needs to pay off.
Yeah, if I put $200 in Apple and it makes 7% return, okay, cool, I've made $15 in profit. But the dude took $15 from me just to make the trade. So I'm at square one off of that. So like
you better make really good trades.
Yeah. So that's the nice thing about Robinhood is I've got a couple of stocks that I'm invested in Robinhood. I invested in United because when that whole thing happened, you remember when they dragged that dude off the plane?
Yeah, they weren't popular.
Freaked out and their stock tanked. I was like, yeah, but United is so entrenched in so many routes. Like it's not like
and people forget bad news pretty quick.
Yeah, people like they can't stay angry for long. So I'm like, all right, I'm gonna buy United, and I've made a pretty darn good profit on that.
Yeah,
because I'm like human psychology is easily exploitable.
And it looks like it is on Android.
Also. Oh, cool! It is on Android now. Yeah. So that's a cool thing to do. But again, build up that big sizable war chest in passive funds because remember, 92% of these professionals can't beat the index. So you probably can't either. And I'll tell you, I've got 2 stocks. So I mean, I tell the United story because it's cool. My other stock that I bought, it's tanking hard.
So that's
it's hard tanking. So I'm not, again, like buy low, sell high. I'm not gonna sell it out of fear because I would just lose everything I put in. It's a low enough investment that if it like went to zero, I'm out like $40.
Like you didn't put a whole lot in it. Yeah.
I put $40 in. So if they go to zero, I'm out $40, whatever. But I'm going to hold it because maybe they'll come up. Maybe it's just like speculation or maybe they need to get better management or something, whatever.
Yeah.
But I do say that because like, okay, I bought 2 stocks. One of them, awesome. The other one is doing terribly. So my average, not that great. Yeah. I'm not beating the market.
You didn't beat the market. Do not let Thomas Frank manage your funds.
No. Let me tell you how to study in school, but don't let me manage your money. That's not my job. Let the robots do that. The other thing is you have to ask yourself, what's my risk profile? So I think this is dependent on a couple of different factors. What is your risk tolerance personally? So how well can you deal with loss? And what's your age? If you're 20 and you put $1,000 in the stock market and it goes to zero tomorrow, you're probably going to be fine. If you followed our advice here, you have $500 in your emergency fund, you're hopefully investing in your career. You yourself are an asset with your labor. So if you lose $1,000 in the market, whatever. If you are 65 and you've got kids or grandkids, you got a wife, you got all this stuff you got to deal with, and you're coming up right against retirement, obviously that risk is not something you want to take on.
Yeah.
So there are funds that are called target retirement date funds. Vanguard has these, Fidelity has these. Basically what these will do is if you're young, they'll start you out mostly in stocks, which are riskier. And then every year, there's like an automatic rebalancing where it'll put some of your money into less risky bonds or treasury notes or stuff with the government. And then once you get closer to retirement, like most of it will be there. So it just kind of shifts over time. The robo-advisors like Betterment and Wealthfront, they do this too. You can just tell it like, I want to retire in 2065 or 2055 or something like that. And every year, it'll just sort of gradually move things over. You don't have to worry about it.
Cool.
You're good to go. So that's risk profiles. Now, I do want to talk about the active investment strategy that I do use. The active investment strategy I use is investing in myself and my company.
Yes.
Because I'm a business person. I'm an entrepreneur. So I know if I take literally all my money that I make from this business, I just suck all the profits out of it and I shove it into my investments. It's like, cool, 7% or maybe 11% on a good year, whatever. But I'm not building my business. Like, it was a pretty significant investment. In fact, I'll tell you, I stopped contributing to my mutual funds for the 3 months that I hired you initially because I wasn't making enough. And I was like, I think Martin is a good investment. Number one, you were like my best friend. And I'm like, okay, you had this injury and everything. There was a reason that I did it, like a human reason. But the other thing is like, I've seen you work. I've seen you be innovative. I was like, I can spot talent when I look at it. And I'm like, okay, if I can bring Martin on, I think he will help me grow my business faster than my investments will grow.
Better than a 7% ROI.
Yes, and I made a good choice.
Which most employees should probably try to be better than a 7% ROI.
Yeah, and so when did I hire you? Was it a year and 4 months ago? I think I hired you February 2016.
Somewhere in there. Somewhere around that area.
So it was a year and 4 months ago. We are making double what we're making.
Better return on investment.
And I'm not paying you all that. So it's a heck of a better return on investment. And that actually brings me to our sponsor this week because I'm good at ad segues.
Ooh, we should do a segue for Segway. They should be my sponsor.
I don't want to be sponsored by Segway.
Too late. I'm talking to them right now.
Though I have ridden one of those little hoverboard things, and they're kind of fun. Anyway, yes. Our sponsor this week is FreshBooks. And apart from that being a very good ad segue, I do want you guys to listen up because this really is something that's important. If you can make investments into your business, or even if you're not a business person, if you can make investments into the way that you work that are going to help you be more efficient, that are going to give you more time to work on the things that actually matter, that are actually like the breadwinning things, then you win out, even if those investments cost money. So if you are a freelancer, if you own your own business, if you do anything on your own, FreshBooks is a great investment because what they do is they let you heavily automate and heavily increase the efficiency of your accounting, of the invoicing, and of the process of getting paid by clients. They had a huge redesign recently, and apart from having a great app on their phone that lets you like scan your receipts and easily mark down your expenses and save money at tax time if you're a business person, the great thing about FreshBooks is they help you get paid faster and they help you spend way less time dealing with the whole process of getting paid.
Yeah.
And I want to use like one of our freelancers as a case study here. So Ransom writes articles for the College Info Geek blog. And he's actually going to start trying to do some script writing too, so I can maybe get 2 videos out per week potentially. He invoices me via FreshBooks. He uses FreshBooks because he's a freelancer. Cool. He's not an employee of College Info Geek. He's a freelancer that I contract. He does work. He charges me. He uses FreshBooks. So what that means is he can create invoices in like 30 seconds. They look great. They immediately come to me in email, and I can pay him online. Yeah, which is awesome. So I can pay him like one click, bam, money to him easily, super quick. And the other thing is, when I get the invoices, I pay right away because I have been a freelancer and I have been on that side of the equation where sometimes like a client doesn't pay you for a while and you're waiting and waiting and waiting. So the moment I see the email, I'm like, I want to pay because I want to be a good client. But some clients aren't so on the ball, I guess is the word to use.
Yeah, they're absent-minded.
Yeah, we'll use that. That's a nice term.
Yes.
So the great thing about FreshBooks is when you send off that email, you get to see when they've opened that email and when they've seen the invoice. So there's no guessing games. You don't have to send those emails that are like, hey, did you see that invoice? Are you ever going to pay me? Are you guys actually still alive? Gary.
Give me my money, Gary.
You know when Gary's opened that email. So, but again, with the online payments thing, it makes it so convenient that you're going to get paid. And with FreshBooks, people get paid up to 4 days faster than with other tools, which is awesome. So, if you are a freelancer or if you're thinking about that, keep this URL in mind, freshbooks.com/CIG. If you go there, you can get a free 30-day unrestricted trial. Use the app, take it for a test drive, totally full featured. And if you do that, put College Info Geek in that How Did You Hear About Us section so they know you came from this show. Sponsorships help us keep this show running, keeps the lights on, and helps us make
cool video equipment.
I know, we're making so many improvements here. I don't know if you guys saw, we did like a excerpt video on the channel a couple of days ago, and I'm hoping to upgrade it further.
Yeah.
I got my eyes set on like multiple cameras. Like,
yeah, we invest in our workflow. Awesome. We invest in our workflow and our future for this business all the time. And investing in your workflow is definitely worth it.
Exactly. So again, FreshBooks is a great way to invest in the accounting and invoicing workflow. We use a tool called Asana, which helps for our project management workflow. It helps us make sure videos get done on time. It helps me make sure I don't forget to pay my taxes or forget to send emails to like an advertiser or something. We do all kinds of stuff.
Yeah.
One thing that I spent some time doing a while ago was I went down and I wrote what are called standard operating procedure documents.
Yeah.
So basically, if I hire a new writer, there is a document that I can send them that shows them exactly how to write a post in our WordPress setup. It shows them all the boxes to check, where to put the featured image, all that stuff. So now I can hire 100 writers.
Yes.
And I don't have to sit down individually and spend an hour training them on what to do. I can send them that document that I wrote once, and they're good to go.
Your dividends will be a short onboarding process.
Yeah. So I can go make more videos, which is what brings the bacon home.
Yeah.
And what helps people. It doesn't really help people in the audience for me to spend time teaching a new writer how to fiddle with WordPress menus.
No.
It makes it, it helps people if I can create a new video or go do some research that helps them out. So whatever it is, ad segue aside, actively invest in yourself. That could even mean like going and getting a certification.
Yeah, you can have a way better ROI if there is still a lot you can improve about your own professional skills, your own workflow, your own anything.
Say you
had
7%. You were in the networking program at your community college.
Yeah.
So say you graduated in that, you got a job in IT, that's what you did. Spending some time to go get a what's it called, like a Cisco cert?
Yeah, I took a bunch of like CCNA, I think.
CCNA.
I took a bunch of CCNA classes, and I almost got certified for a Linux thing. That would have been cool.
So if you get those, like the next job you go to, you can be like, yo, I have a CCNA. It took me 30 hours to study for it. I paid $300 for the test, but now I got
can
the
make
certification.
Like $2,000 more a year.
Awesome. We're going to hire you for $70K instead of $60K because you have this. We know you can do this. Make investments in yourself.
Yeah.
All right. I'll stop beating the dead horse. We are going to move on to something almost everyone who ever gets a job is going to run into. Full-time job, at least.
Okay.
The 401k.
Yes.
So, a lot of times when you get a full-time job, one of the benefits is a 401k account. Now, this is basically a company-sponsored investment account, and this is a vehicle that can funnel money into like an IRA or retirement account or a not IRA, like just regular investment account, like what I use for the most part. But the big thing is, and this is like the selling point of a 401k, a lot of companies will match what you decide to contribute out of your salary to a certain point. So, example, say you get hired at Acme or whatever for making dynamite that doesn't work, so the coyotes can't catch roadrunners. They're doing real good at that. Yeah. I always wondered, is Acme like a conservation company secretly that's trying to build the roadrunner population back up by selling really, really bad
Looney Tunes conspiracy theories.
Yeah. Looney Tunes is a conspiracy theory.
Fair.
Turtles all the way down.
Turtles all the way down.
I think this is the second podcast where I've made that reference.
Yeah, pretty sure.
Anyway, say you get hired at Acme for $50,000 a year. So, taxes aside, there's going to be a certain amount that you bring home every month. It's called your take-home pay. Now, if you decide to contribute to a 401k, that will actually come out of your paycheck before you take that money home and gets invested into some investment account. So say I opt to invest $100 a month into my 401k. So I'm taking home $100 less, but it's being invested for me. Yeah. And the company's like, cool, we'll match that. We'll actually match the $100. Now, a lot of companies are not going to match exactly what you put in. They might match like 10%, or they might match up to $2,000 a year. what you should consider that match to be is a raise that you can get simply by actually contributing.
Yeah.
It's 100% return on investment.
Yeah.
For whatever that match is.
If they match up to 3%, then
yeah.
you invest at least 3%. You get another 3%. Why not? That's the best investment you can make.
Now, there's some nuance here because a lot of people are like, cool, I'll just put everything that I want to invest into the 401k. Right? Makes sense, right?
Maybe. I would only go up to at least the minimum and then think about it after that.
Exactly, yeah. So my recommendation is invest up to the match because you're getting that 100% ROI, but then think a little harder about investing any more into the 401k. Because here's the thing about 401ks. A lot of them limit your choices of what funds you can be invested in, and a lot of times they're either just arbitrary choice on the part of whoever made the selections, whoever runs the 401k, or due to more nefarious reasons sometimes, all the funds you're going to have access to in your 401k might be high fee funds. So, and one of my last things here is to show you like what a fee can do to your account here. So I say embrace having more choice because you're learning what to use from this podcast.
Yeah.
And take any money that isn't going to be matched and make a more deliberate decision as to where to invest it. Now, maybe your 401k is awesome.
Yeah, but don't invest by default.
But don't invest by default.
Intentionally.
Yeah, so once you hit that match, you're just like, all right, my 401k doesn't offer that many great funds. I'm going to take every dollar that I would have invested past that matching limit, and I'm going to put it into my cool Vanguard fund over here. Or I'm going to put it into my Betterment account. Boom.
Cool.
All right, now we're moving on to saving for retirement. So I want to quickly explain what IRAs are. And obviously this is investing basics. This is for beginners.
Yeah.
So we're not going to talk about things like simple IRAs, which are in fact not simple, or SEP IRAs, or anything like that. We're going to talk about the two types of IRAs which most normal people are going to use. Traditional IRAs or Roth IRAs. Now an IRA is called an individual retirement account.
Yeah.
This is basically an account that you contribute money into as you're working, and there is some sort of tax advantage. That's why there's a difference between Roth and traditional. But in most cases, you can't take that money out until you're 59 and a half.
Yeah.
So it's for retirement. Now, the difference here is that the Roth IRA is, let's see here. If you have higher taxes when you retire, you want to do a Roth. And if you have lower taxes when you retire, you want to do a traditional. So with a Roth IRA, you're taking post-tax money, meaning you get your paycheck, your employer already took taxes out of it, and you're putting money into the Roth. So you've already paid taxes on that money.
Yeah.
But when you take that money out of the Roth, it's not taxed, which is pretty awesome because the gains aren't taxed either. So that's a pretty sweet deal there.
So you pay the tax now, but not later.
Yeah. So you're not, so say, and there are contribution limits here, but say you have put in a total of like $50,000 over your career, but it grew to $300,000, you're not getting taxed on that $250,000 that it just grew to.
Okay.
Which is pretty awesome.
And which one is that?
That's the Roth.
That's the Roth? Okay.
The traditional has a different tax advantage. The traditional is pre-tax money being put in now, which means it lowers your income for the year. So say your salary was $50,000, but you put $5,000 of that into a traditional IRA. What you actually made this year is $45,000. So right now, you're only going to be taxed on $45,000.
So are you more tolerant of paying those taxes now or later?
That's
basically the question.
Well, the question is, what's your tax bracket going to be when you're older versus now?
Yeah.
Most people, when they retire, they're probably not going to work anymore, so they might be in a lower tax bracket. And in that case, a traditional IRA makes sense. But if you're like me, you're a baller entrepreneur who's going to go hardcore until he dies,
Yep.
I fully expect to be making more money when I'm 65 than I'm making now. So it would make more sense for me to use something like a Roth.
Okay.
Or to do something like taxable investments, which is actually what I do. I just don't even care about. And I mean, I do some retirement investing, but as an entrepreneur, I find it makes more sense for me to keep it in a place where it's not locked away.
A place where you can use it to invest in something better.
Yeah, maybe I decide, maybe tomorrow there's like some amazing opportunity that's going to grow my business 10 times, but I need $10,000 for it. Well, if it's locked away in my retirement account, I can't use it.
Okay.
But for most employees, people who work for other people, that's not a situation that comes up that often. More often it's like, I really want a new truck, man. And you don't need that. So we'll talk about, there's contribution limits here. If you're under 50, combined between the Roth and the traditional, because you can have both if you want, $5,500 a year is the contribution limit. Okay. If you're over 50, it's $6,500 a year. Now, the Roth is limited by your annual income. If you make over $133,000 a year, you can't do a Roth at all. So basically, if you make up to or under $118,000 a year, you can do up to that whole $5,500 in Roth if you want. Between the 118 and 133, there's like some schedule that can go into Roth.
Interesting.
And if you're over 133, no Roth for you. They want you to pay the taxes when you retire.
Okay.
So yeah, the other thing is, if you for some reason have to take money out of a retirement account, it's better if it's a Roth, because there are circumstances, we can link to them in the show notes, where you can take money out of a Roth without a huge penalty. If it's in a traditional, you're taking a 10% penalty, and then they're taxing the money. So it sucks.
That's a super emergency. That's bad.
Yeah, that's like an emergency. So don't take it out before you're 59 and a half. And I mean, your mindset, if you're doing a retirement account, your mindset should be that money's not being touched until I am 59 and a half or retired. The other thing is here, IRA versus taxable investments. Taxable being like not in a retirement account. I'm paying taxes on my income and then just putting it into Vanguard, whatever.
Yeah.
We talked about the entrepreneur mindset. The other mindset is what they call like the FIRE community, financial independence, and I forget what the RE stands for.
FIRE community right there.
FIRE, yeah. They listen to mixtapes.
Yeah.
Everything's on fire and on fleek. So basically the FIRE community is like, I want to retire early. I want to retire when I'm 40. How do we do that? And they do all the math to figure out exactly what they need to do, how much they need to save, so they retire at a certain age before the traditional age.
Okay.
So basically, this comes down to something called the 4% rule. And the 4% rule hinges on that 7% average we talked about in the market. So they go, all right, if I've got my money in an index fund, on average, it's going to make 7%. So if I just take out less than 7% of that fund's value to live off of, it will never shrink, because it's always going to be growing faster than I'm taking away from it. But they use the 4% rule because it's like a safety. So they're basically like, all right, 7% is the average. Let's just assume, to be conservative, that 5% is what it's going to grow at. So I can take 4% per year and live off that, and the money will never shrink. It'll keep growing.
Okay, you want to invest so much that you can live only on its interest.
Yeah. So the funny thing is, I talked about, this is not a new concept, but I talked about this on Listen Money Matters once, and I figured it out. I think it's on my impossible list. I figured out how much money I would, need to save to retire at 40, and I went on TV for that. Like Newsweek emailed me and they're like, "This is cool. We want to write an article on you." And then I was on like Fox Business to talk about it.
Fancy.
So that was fun, but it's not a new concept. It's just like, it's cool. So like, I don't remember the exact math, but I think I figured out if I had $900,000 in an account somewhere, then I could take $36,000 a year to live off of, which is like $3,000 a month. So if you're living modestly, you could do that.
Yeah.
So it's like, all right, how much money do I have to save every month to get to $900,000 by the time I'm 40? That's the whole FIRE thing. And if that is something you're interested in, then obviously you don't want to be locking your money away in an IRA, because if you want to retire at 40, that's still 20 years away from when you can take it out. All right. So we have a couple of more sections here to talk about before we close out. The first one is how do you invest? Do you dump it all in at once, or do you spread it out? So spreading it out is what I recommend, and this is a strategy called dollar cost averaging. So basically, a lot of people get this in their head. They're like, buy low, sell high.
Buy low,
so
sell
I'm going to
high.
try to time the market. I'm going to get a bunch of money, and I'm going to be like, all right, the market sucks now. I'm going to shove it all in while the shares don't cost much, and hopefully they'll grow more.
Yeah.
Now, the other option is what's called dollar cost averaging, where you don't think about timing the market. Just every month you put some money in, and over time,
it's an amount of money, not
an
amount of stocks.
Yeah, so you're not like, oh, I'm going to buy 100 shares this month. It's like, nope, I'm putting in $500.
No matter how many stocks it buys.
Yeah.
Okay.
So that's like the two different ways you can do it. It's like lump sum investing once a year, or trying to time the market several times during the year, or just once a month, I invest. Now, we actually did some research here.
Yeah.
Because a lot of people recommend dollar cost averaging to the everyman. There was actually a market analysis that we can link to in the show notes that looked at like every year since 1935 up until 2017 or something like that, and found that like lump sum investing does beat out dollar cost averaging in returns 2/3 of the time or something like that.
Yeah.
So mathematically, it probably works better because you're getting money into the market sooner, and the stock market is up more often than it's down.
If
like
you happen to have a crazy lump sum to throw in, right?
But that's the thing. If you happen to have the money. That being said, I still recommend dollar cost averaging. And here's the reason. Everyone should invest, but not everyone should think of themselves as an investor. As in like, I'm actively trying to find the strategies and optimize everything, blah, blah, blah. Because when you do that, I mean, there's nothing wrong if you want to do that. If you're genuinely interested in the math and the strategies and whatever, cool. I'm not going to try to discourage you. But most people, they want to be secure for retirement. They want to set up a system that will enable them to do that. And then they want to just carry on with their lives. They want to pursue their passions. They want to play guitar. They want to become better entrepreneurs or better employees, get certifications, or spend time with their girlfriend. And if you're spending all this time trying to optimize and time the market and you're looking at reports every morning, that's eating into that time.
Yeah.
So what I recommend you do, and this is what I do personally, I have in Vanguard and in Betterment automatic deposit days. We're just like one day a month, it pulls a specific dollar amount from my bank account and buys whatever that will buy.
Okay.
Sometimes it might be 100 shares, sometimes it might be 80 shares.
So you may get a little bit smaller of a return, but the return you really got was time.
Yes.
And lack of stress and trying to be all fancy with the numbers.
And I believe that most people are going to end up with a higher return anyway. Because if you're sitting on a bank account and you're just like, I'm going to time that market so good, and you're just like shoving money into your bank account every month. I can wait
real good.
What if you're like, man, I've got $10,000 in my bank account right now, and I know I was going to put all that in the stock market at the right time, but actually, I've really been wanting a Nintendo Switch. What if I took some of that money and it's just like $250?
Yeah.
Most of it's still going to the stock market. The longer you have control of that money and the more liquid it is, the more you got to deal with that temptation to use it for short-term rewards. Your brain is not optimized for this stuff. So let the robots do it.
Yeah.
That's my position.
And the more you'd be able to say, well, now that I have it, maybe it'll be a little lower next month. And then you just think that over and over and over, and then you've lost an average 7% or whatever because you didn't get in sooner.
Greed and fear are what drives losses for most people.
I would say that greed and fear drive a lot of things. Just everything. But
you are very right.
Yeah.
Yep.
Yeah, that's fair. And I think the auto deposit has an extra benefit of you don't feel as hurt losing. So like freelancing and stuff, I got to save up taxes separately, and it feels bad to see that. It hurts. It feels really bad to see the tax checking account I have get really big and then go away. But if that was I never had it to begin with, so working a traditional job, they take the taxes out beforehand.
Yep.
It doesn't hurt.
I never feel it because it's
I
all
never
that
had
loss
that money.
aversion.
That money was already gone.
Yeah.
It wasn't a problem. So auto depositing would make you feel less like you're losing money that you could have used. You'll just get used to the smaller amount.
I mean, it is coming out of your bank account, but it's auto. So
yeah, but if it's auto, it's not your decision.
I never notice it happen.
To hurt.
I mean, I guess they send me an email. So they send me an email. $150 has gone to this account. Boom. All right, that's fine. But it already happened. I didn't have to make the choice.
Happened. You
that's
weren't
the
like,
thing.
Should I hit the button?
That is the thing.
I kind of want to do something better. I want to have fun with that. But should I hit the button? No, you hit the button.
A robot hits the button for you, tells you, I have just hit the button.
Yeah, I don't care if you wanted new shoes this month. You should have saved up somewhere else.
Exactly.
You're investing.
Yeah, so do that. All right, the last thing I want to talk about before we finish up here is fees. We've mentioned here some funds have higher management fees than others. So I want to do an example here.
Okay.
So let's say you invest in a fund with a 1% management fee. So that means like, just for simplicity's sake, every year they're going to take 1% of your portfolio's value as their fee.
Okay.
Let's see how that eats into your overall returns because of compound interest. So say, in this example that they did on nerdwallet.com, we're going to have the link in the show notes so you can look at it. There's a lot of detail that we're not going to mention here. So if you're a nerd with a wallet, you can check it out. If you're 25 years old, let's say you've got your $25,000 in your retirement account right now. You've already got it. You're 25. Good job. And you're going to be contributing $10,000 a year. So a little less than $1,000 a month. That's quite a lot, but it's doable for some people. and you're going to retire in 40 years, 65 years of age. 1% fee on that fund equals $590,000 in lost portfolio value over that 40 years.
That hurts.
That's huge. So let's contrast that 1% fee against what I pay. My Vanguard Total Stock Index Fund, the Admiral shares, has a 0.04% fee.
Okay.
It is over 20 times lower. My Betterment fee is, I believe, 0.3%, so higher than that Vanguard fee. But I did say earlier, Betterment right now is doing better than the Vanguard fee. So again, I mean, this is the thing you have to think about. If somebody comes up to you and they're like, I have a fund you can get into, but it's 2% fee, but they could guarantee you 20% return, that's a no-brainer.
Yeah.
No-brainer. But most of these managed fees managed funds with these bigger fees, as we said before, can't even beat the index. 92% of them can't beat it. So it's like, all right, I'm charging you 1%, sometimes even 2%, to not beat the fund that charges you 0.04%.
Yeah, and that's really tricky because, like, if you don't know about that beforehand, 1%, like when you said that, I was like, okay, somehow this is going to end bad, but 1% sounds real small. It does sound small, and it feels small, but when you do the math,
exactly,
our brains weren't really built for these big numbers. So
they weren't. Okay, so I am coming to the realization that everything we have just gone through is probably daunting. There's a lot of it.
Yeah. So what if it was real simple? Give me a checklist. If I want to start investing tomorrow, I'm gonna do it tomorrow. What do I do?
Cool. All right. Number one, you build up that emergency fund, $500.
Emergency fund.
Number two, make your debt decision that we talked about.
Oh yes, decide on whether I want that psychologically gone or what.
If you want to totally get rid of your debt, do that first.
And if you have high interest rate,
anything over 5%, kill that debt first.
Yeah.
Then, now you got to decide where to invest your money. Regardless of what you do, I recommend doing an automatic deposit every month, so it's not in your hands. The choice is taken care of for you. It's just a robot is investing your money, and when you're 65, you're going to be like, thanks, robot. And it'll be like, you're welcome, sir, and also I'm sentient AI now.
Cool. Well, then they'll probably be even better.
Can I become part of your family? Yeah. Now, as to where to go individually, my two recommendations, Betterment is like the easiest, zero effort, zero thinking option.
I do like easy.
Yeah. Or Wealthfront. I have Betterment, but Wealthfront is like basically identical, and there are other ones out there. Unless the money matters, we recommend Betterment because that's what we've used.
Okay. So
try that. If you want to get into lower fees than Betterment can even get you, and you're willing to do a little bit more research or just be a little bit more manual, the Vanguard funds are great. The thing is, the Admiral shares version of that total stock market is a $10,000 minimum, and the investor shares, which is like a little bit higher fee, like I think it's like 0.2 or something like that.
Okay.
That's $3,000. But, and I was doing research on this right before this podcast. They have what's called an ETF version of that fund. So it's like an exchange traded fund. Literally the only difference between like the mutual fund version and the ETF is that the ETF is traded like a stock. So throughout the day, its prices will fluctuate just like Apple stock or, I don't know, Chevrolet or whatever. Whereas the mutual fund can only be traded once a day. So the price doesn't fluctuate.
Okay.
But for all of you who are going to be long-term investors and you, that difference doesn't matter. So the other difference is the ETF has no minimum investment at all. The only catch is you have to have a brokerage account to buy it for you. And a lot of brokerage account, like if you go down your Edward Jones, which don't do, you can set up like a brokerage account with them and they can like buy that for you. But a lot of brokerage accounts are going to charge you a commission to set up that fund or to buy that and make that trade. But, and Andrew was just telling me this over iMessage recently, like 5 minutes ago before we started. You can set up your own brokerage account as a Vanguard account. You can just go to the Vanguard site, set it up yourself, and there's no fee.
Oh.
So I haven't done this myself yet, but that's what he told me. You could literally get into the ETF, get the same super low management fee, 0.04%. On the ETF version, there's no difference for a long-term minded investor. There's no what is it called? Minimum investment. Cool. So you got to go through a little bit of hassle to set up that brokerage account.
Yeah.
But other than that, like that seems like the easiest way if you have not a whole lot of money to get into the cheapest and most stable and easiest, like just long-term solution.
Okay.
So that's my recommendation. Betterment if you're like, I really don't want to think and I want robots to balance things for me and potentially have better gain, or get that ETF if you're just like, I want to follow the economy the way it goes.
And I think the way I'm going to do that is I think I'm probably going to do Betterment first to dip my toes into the investment waters before I scare myself off trying to do thinking about stuff.
Yeah, that's true. Yeah, I mean, even though that fee is a little bit higher, like just get started.
Getting started is the thing, and maybe after even just a little bit of time on that, suddenly I'll be like, you know what? I'm comfortable with this now. I understand more, so now I'm going to do the fancy things.
Yeah.
Okay.
Exactly.
Cool.
So that is my beginner's recommendation. If you guys want to go further, we can. I guess the first thing is like, let me know down in the comments or email us or tweet us or whatever. What do you want to know? What didn't make sense here? Is there something else related to personal finance that you would like us to cover on the podcast? I am totally game to do more personal finance and even investing related episodes if they make sense. The other thing though is I have a second podcast called Listen Money Matters, and I do that with my friend Andrew. We get into the details of like every financial topic you could think of. It's not one of those shows where we're like, here's what happened in the market this week. No, it's like, what the heck is an ETF? What the heck is dollar cost averaging? And we'll like interview CEOs of companies. We've interviewed the CEO of Personal Capital. We've interviewed people who work at Betterment and Wealthfront and like tons of experts and authors, economists. It's a good show if you want to learn how to manage your money. So check it out. listenmoneymatters.com/show, and we'll have that link in our show notes, which you'll find linked in the description below if you're watching on YouTube, or over at cigpodcast.com/168 if you're listening to this on the audio feed and you need to find a URL to go to. So definitely check out those show notes. In those show notes, you will also find a link to rate and review this podcast on iTunes. That is a great way to support this show. It lets us know what we're doing right, what we're doing wrong, how we can improve, and we're really trying to improve as much as we can.
Yep.
And it also helps to bump our show up the charts in iTunes. So if you want to help us get this show out to more people and impact more lives, that's a great way to do it. The other thing, before we close out, once again, I want to thank FreshBooks for sponsoring this episode. And if you are a entrepreneur, if you're a freelancer, if you work for yourself, go over to freshbooks.com/CIG and put College Info Geek in the How Did You Hear About Us section to start that 30-day unrestricted free trial and start investing in yourself.
Yep.
That's about it, right?
Yep.
Cool.
Thanks for listening. Papa bless.
Papa bless. Don't drink them sody pops.
Nope.
And we will see you next week. Stay cute.